well, so. Got it.
All right. Good afternoon, fellow Realtist members for California Association of Real Estate Brokers and family. Welcome to our fourth Power Hour for the calendar year 2022-2023. It's been my pleasure as your third vice president to actually serve you and the members and to bring some great opportunities to learn and to expand your business. One of the things that we are focused on, especially as the education committee, being chair of the education committee, is to make sure that we bring the right information to you at the right time. Like today, we are going to be talking about taxes. We are in tax season right now, and maximizing your taxes, especially in a year like this, is going to be very important for a lot of real estate professionals. So there's information here. We have two panelists, and they're experts in their industry, and they're going to be going to introduce them as we speak. As we start, before we start, I have some of my leadership here at California Association of Real Estate Brokers to introduce themselves. I know we don't have Miss Frances Young, just in time, our president. Would love to hear from you if you want to say a few words.
You gotta take yourself off mute, Madam President.
Oh, okay. I said thank everybody for coming out and supporting CAREB. We're off to a good start this year. And thank you, Mr. Clinton, for your hard work and diligence and making sure that we stay on schedule and the rest of our team. So just sit back and enjoy the session. Thank
Awesome.
you.
Thank you, Madam President. And then we
You're
have
welcome.
our parliamentarian and chairman of the board, Marie Sturgill, keeps everybody in shape and everybody up to date. If you want to introduce yourself.
I just wanted to say hello to everyone and just looking forward to this great information and hope to see everyone next week at the Midwinter Conference.
Awesome. And then we have Rhea Cotton. She is actually second vice president. And if you're seeing all these flyers and the newsletters coming out, she's the one that's putting these beautiful that information out there. So go ahead, Rhea, introduce yourself.
Good afternoon, everyone. My name is Rhea Cotton Landry, second VP of CAREB. Happy to serve. And as Chairperson Marie mentioned, Midwinter is next week. So thank you, Clinton, for providing this great information. And I'm looking forward to more information for our members as a membership benefit. And I'm eager to hear about what everyone has to share today about taxes, because yes, it is definitely tax season.
Yes, the T word. Yeah. So as we start, I want to introduce the two experts we have here. Jordan Marks. I've known Jordan Marks for the past couple of years, introduced to me by Denise Mathis. Jordan Marks is actually the new county assessor, recorder, and the county clerk commissioner of civil marriage ceremonies for the county of San Diego. Jordan was elected in November of 2022, just last year, for his first term as our county of San Diego assessor, recorder, and county clerk commissioner of civil marriage ceremonies. Prior to his election, Mr. Marks served as the chief deputy assessor, taxpayer advocate. In this position, he assisted taxpayers with navigating issues in the office. He led the office countrywide award-winning educational outreach programs and corrected systemic issues. Jordan has personally resolved over 1,000 customer care issues. Thanks to Jordan's outreach, San Diego's taxpayers received an unprecedented property tax savings in 2022, topping $260 million. This included $32.8 million for homeowners and seniors and $18.7 million for disabled veterans, and over $210 million for renters, schools, charitable organizations, churches, affordable housing, and homeless services. Jordan was recognized as a San Diego taxpayer watchdog for his innovative programs that help make San Diego County the #1 assessor office in California for helping disabled veteran owners, and for writing the law that expanded property tax relief for wildfire survivors and victims of natural disasters. Jordan has helped San Diego seniors save thousands on their property taxes by using Proposition 19 senior exclusion from reassessment. His outreach has helped seniors retire with dignity by upgrading their lifestyle without increasing their property taxes. Jordan is a member of CAREB San Diego. Jordan is a licensed attorney and certified property tax appraiser in California. And Jordan received a Bachelor of Arts from the University of California, Los Angeles, UCLA, and a Juris Doctorate from the University of Buffalo School of Law. He is also a graduate from the University of San Diego Cybersecurity Executive Certificate Program. And Jordan was most recently served as a San Diego Hispanic Chamber Board member and volunteers as a leader on the USS Midway Museum, the Small Business Development Center, the San Diego Coast Guard Committee, San Diego Oasis Senior Learning Center, and many more organizations across San Diego County. So Jordan is also married at the County of San Diego Clerk Waterfront office and has a son and just recently became a homeowner. So let me take a breath. We have Jordan Marks here, and before we introduce Jordan Marks, we also have one of our own Realtist members, Darlene Weaver, who is currently managing partner of Downtown Realty Inc. in Antioch, California, and co-owner of Tax Break. She owns and operates 3 locations in Antioch, Dallas, and Houston. Darlene has built over the last 25 years a portfolio of 100 properties and has helped thousands of Bay Area residents to buy, sell, and invest in real estate. So as you can see, we've brought to you 2 top dogs, two people who are experts in the industry, both on the housing side, which is the county and the state side, and the city side, and then we have someone who's on the private side who can tell us about taxes. So I would like Jordan to kick it off. So it's yours. The floor is yours, Jordan.
Well, I appreciate that, Clinton. And after reading that bio, I think I'm ready to say thank you for having me here. It was a pleasure, and I appreciate great being with fellow members of CAREB and the opportunity to help serve today. I think when I was thinking about taxes, I was thinking about how do you use taxes to increase your success in 2023. And so I want to give you a couple of ways that you can touch the folks in your community, help them, and at the same time, maybe get a couple of great deals helping folks into home ownership. And so that's the kind of take that I had from this opportunity. And so I want to start with Prop 8. When Proposition 13 was passed, it gave the ability to have more affordable property taxes because their affordability comes from the predictability. And because you can predict what your taxes are, you can budget for it, right? And we all know helping people budget to get to achieve home ownership is important. After that, voters passed Proposition 8. Prop 8 said if your tax value is greater than the market value on your property, then we can actually reduce your property taxes. And so right now, our office is proactive in the County of San Diego. I think you heard from Clinton. I really enjoy saving people money on their property taxes, homeowners, seniors, veterans, and like. But this is a great opportunity for you to go back and look at those past 2 or 3 years of deals and say, is the value on those homes less than they might be what they paid for? That doesn't mean in the long run they're not going to make money on their deal, which is awesome, and I think they get it. We want to help folks achieve wealth by having their property over 20 years and have those opportunities, right? But in the meantime, if they bought their home for $1 million in the last 6 months, and then now the property could sell for $900,000, that means we could be saving your clients $1,000 a year on their property taxes this year. And while it's not necessarily something that's going to create a deal for you today, trust me, they're going to appreciate you and know that you're their trusted expert. And so, one, you get to help save your clients or you yourself if you bought your property. And if those comps come back and say, hey, this is less than what they paid for it plus that potential 2%, then help them file a Prop 8 application. It's a very easy process. It varies based on the county that you're in. And like I said, my county is very taxpayer friendly and forward. I know I'm talking to leaders across the state, but my office is proactively identifying San Diegans that bought and might be able to lower their taxes while they own their home. And just to kind of give you an idea of what that looked like in 2009 when we had the market hit, that was a different situation, but we proactively lowered the taxes for 300,000 people. And we said, by the way, if we should be lowering it more, tell us, right? If we should be lowering it more, tell us. If not, then we're going to return it, and we have to check it every year and see if it still needs to be reduced or raised. And so I'm just thinking, as we spread wealth in the community and while we help people achieve home ownership, this is a great opportunity to help those folks that trusted you to enter the home buying process within the last year and are going to trust you to know that in the next 7 years, they're going to continue to see wealth and opportunity through that home ownership. But let's save them a couple of tax dollars in the meantime. Second opportunity using taxes is Prop 19 senior transfer. The senior transfer, right now, folks retire not necessarily based on when the market's doing, but based on what their needs are in their life at that moment. And so unlike that building for that first home, this might be a different place in life where they're like, okay, I don't mind where the market's at, and I don't mind the interest rate for various reasons. They're taking money off the table. They might be moving to a different state. They might be moving to a different area. And so the senior transfer, especially if they're staying in the state of California, is a great way for them to save and be able to upgrade their lifestyle without increasing their property taxes. And the way that works, as a reminder, is they sell their first home. They're over 55. So now I want to say again, 55 is the state's definition of a senior. It's not my definition of a senior. I think 55 is the new 25. So I just want to put that out there, but they have to be over 55. It has to be their primary residence, and they can sell it and keep the same low tax base if they're buying a property under the amount they sold for. So whatever they sold for, that is the cap. So if you sold your home for $2 million, if you buy for anything less than $2 million, your taxes stay exactly the same. And if you buy above that, I'm using the bigger numbers, Clinton, because we're talking to Northern California folks. So I know they got those $2 million, that's average price in some of those neighborhoods. But if you buy above it, then that difference gets added onto your old tax base. So for those folks that have been in their homes 30, 40 years, or even 10 years these days, right? I bought my home in 2014, and in 2023, the home value has doubled. If I was 55 plus and I wanted to move and, transition to an apartment or transition to a different property, or I wanted to bring my kids in, that intergenerational buying, which we are seeing, so people can afford to keep their kids with them. They're doing granny flats in the back and then giving the kids to their house, the main house to their kids. You can do that and think about how to take care of your family in this tax environment by keeping that low tax base. And so for those of you, and I know we probably have some great fellow members in the title industry, say, hey, this is my farm. Send me the assessed values. Let me see. And you're going to see low numbers. That means that they have a greater savings incentive, and talk to them about upgrading their lifestyle. Maybe it's time to right size. Maybe it's time to do something that better fits them. They can take money off the table and still keep that low taxes that they budgeted their retirement on. So those are two primary opportunities that I see in the market today to touch folks in a meaningful way and help them. One is a proactive, let me help you save right now. Okay. In the assessor's office, we look at the value of the property for Prop 8s based on January 1st lien date. So I want you to know that if you're a realtor and I'm going to go look up comps, it's not comps based on today, February, it's based on January 1st. So if they bought their home in April of 2022, you're going to look at the value of the home in 2020 at January 1st, 2023, and that difference is their potential tax savings, if at all. And then you can send them the Prop 8 form from each assessor website and make it easy for them. People never forget the folks that save them money and help them gain more wealth and opportunity for their family. And then again, working your field, helping seniors think about their opportunity to transition. And remember, they get it 3 times now. Use that title information. Look at those assessed values and say, okay, that person has $100,000 assessed value and the average home price is $1 million. That's a $9,000 savings, and they might be afraid to move because of that increased taxes. Let me help them. Let me help them and make the most out of it. And again, you do this in concert with your IRS professional, because everything that you do has federal tax consequences and local state and local tax consequences. But this is the opportunity to readjust and deliver more wealth and opportunity to our clients and our community.
Awesome, Jordan. So do we have any questions for Jordan before we move on to our next panelist, which is Darlene Weaver? Yes, I see it. Madam President Francis, go ahead. I think you're on mute.
You're on mute.
Okay. I was wondering if it were possible to get your own appraiser, or is there a network of appraisers to give that value?
So we have appraisal principles that we operate with, which is a little different than the fee appraisal that you're used to from a bank. But quite honestly, Francis, this process is not meant to be formal as needing to order an appraisal. You don't need to order an appraisal. You are the professional and you know how to appraise a property, right?
Yes.
So if you go pull comps based on a January 1st date, which you can do, right? And you could even say, hey, you know what? It's February today. It's not too far off. I'll just pull it based on today's date, which is fine. There's a 90-day bleed each way. So there's a little bit of leeway because not every comp avails itself right on that exact date, right? But you can run the comps for them based on today and kind of get a ballpark on what their savings might be if available to them. And then tell them to apply. And then the assessor we have to do our own appraisal on it. And they're going to say, well, the assessor said it, this is what we found it to be. And you're like, that might be higher or lower. Let's show them my comps and then have them, adjust it based on that and work with us. Appraisal, as you know, is an art. What you do is an art. It's not a science. There's no 1 + 1 in the comp field, right?
Yeah.
It's, well, this kind of looks similar. So that's what we work together. But you're going to know based on your expertise and being a realtist whether or not there's a potential savings.
Yeah, thank you. I was successful in helping my brother get his property, and our tax assessor in the area, I sent out, the guy came in higher in the area than it should have been. So by the time I gathered comps and sent it in and rebuttal, then we were able to save that money in taxes. So I know it works. It's just a matter of
It's a partnership.
Yeah. Mm-hmm.
And in my office, we have an informal appeal period that's coming up. It starts in April, and you just send it over, and we can just enroll it right away if we got it right there. That's where we try to be.
Sounds good.
All right. Any more questions before we let Jordan and move on to leave and go on to our next guest?
Deidre Davy has her hand up, Mr. Clinton.
Go ahead, Dee.
Good afternoon. I just want to make sure I understand. So with the Proposition 8, the decline in value, it has to occur when the county does the assessment, or does it have to be within the year that they purchased the property?
So it's the following lien date. So if you purchased any time before December 31st, 2022, could have been 2021, it could have been 2020. And we look at the value as of that January 1st, the next year. So that's the date that we look at. So if you had a client that bought a home in 2021, and then the home value in January 1st, 2023 was lower than that in the market, we can save them money.
Okay, got it. Thank you.
And just to kind of give you an idea, it's a decline in value. It's a temporary tax relief. So as we drop it down, it comes back with the market, but never to exceed that Prop 13 locked in value. So your folks will not jeopardize their Prop 13 protections at all.
Perfect.
Awesome. Great questions. Any more questions? All right. So what I did is I went ahead and put Jordan's contact information in the chat. He's always receptive. I refer him even to my neighbors. So at the same time too, but he's very busy too. So, but he has a staff that works with him to help him answer these questions and stuff. So if you want to reach out to him, his information is in the chat. Well, I want to say thank you very much, Jordan. I know that you're stressed for time. Thank you for taking the opportunity to come to this workshop and talk to our CAREB members. We do value that, and thank you also for being a member. Hope to see you at Midwinter.
I will, and I updated the contact there, so I gave you all my county information. But Clinton knows. You send out a courier pigeon, I'll try to catch it.
Okay.
Take care, everybody.
Thank you. All right, thank you.
Thank you, Jordan.
Right. So our next guest host, as I said, is Miss Darlene Weaver. I did an introduction for her earlier today. I'll give her the honors of introducing herself to the new people that just came on. But the floor is yours, Darlene.
Okay, good afternoon, everyone. So good to see your faces. And I'm Darlene Weaver, and I am a managing partner of Downtown Realty in Antioch, California. I am also a owner of Tax Break, a co-owner and a tax strategist company called Tax Break. I currently operate 3 locations. I have added my office in Antioch. I also have an office in Houston and an office in Dallas. I am also a credit repair specialist. So all of those things kind of go hand in hand. I've been in the real estate lending business for close to 25 years or so. I'm a native of Richmond, currently live in Bethel Island, California, went to college in Texas. So there's my lifespan. Married to an awesome guy from high school, and have 2 gorgeous kids. So today we're gonna anybody got any questions about any of that? No? Okay, we're good. Okay. So today we're gonna talk, I'm gonna share my screen with you, and we're gonna just kind of go over a few strategies that we or you guys as realtors use in the business, right? Or can use for tax write-offs. A lot of, if you've been in the business a while, a lot of you guys know most of the things you can write off. There's just been a few changes, but for the most part, everything is kind of remains the same. I had the opportunity to be at an event yesterday, and I sat on the panel with a CPA, and he kind of gave me some tips that I will also share with you all. But for the most part, we all know where things that we can write off. This is kind of to show you exactly where you would look to see that your accountant or your CPA or your tax preparer is writing off the things that you should be writing off. So we'll just kind of get started, kind of go through it a little bit quick and make sure we see if you guys can see my screen here. Shortly, can you see my screen?
Yeah, we can see it.
Okay, I have to get you guys off of it. So let me see if I can move this around. My view. Okay, so here is my team that is in Antioch. Carla, she's a specialist. She's been in the business for about 11 years. Erica's been in the business 3 years, and Vinciana, which is my cousin, and we also own the Tax Break franchise, and she's been in the business a little bit over 2 years. For most of you guys who do not know, I don't know why my printer decides it wants to talk right now. It's not printing anything, but it is making some noise. I'm trying to, okay. So anyway, our code that we use in the business is 531210. This code is the IRS code that basically says that licensed agents, or we work in the real estate, because it goes for investors as well. Deductions that, these are the typical deductions that we basically take as realtors. We get paid for, we get to write off some of our commission. If you have a home office, you get to write off your home office. There's a couple loopholes in the home office. I also want to take a little break here and say, if you have desk fees, you get to write that off as well. However, you still get to write off your home office. And your home office does not have to be a home that you own. It could also be the home that you live in and you're a renter. But you get to write off a portion of your home office. And how you write that off is, if you pay the majority of your bills for your business from your house, then you get to use your home office as a write-off. So if you perform any kind of record keeping or bookkeeping that you're at home, then that could be considered your principal place of business. So keep in mind, even if you pay desk fees at your broker's office, you still get to write off a portion of your home office as well. Any kind of education and training, you get to write that off. Of course, we know. So any continuing ed classes, you get to write that off. It's also different if you get an education credit if you attend any type of university or community college. That is different from the continuing ed classes that you are taking. You get to write those off as well. Marketing and advertisement expenses, we get to write those things off. Office supplies and equipment. Oh, let me go back to the home office thing. I made a little note here. For those of you who have children under 18, you can, or all the way down from 18 down, you get to write off in your home office a part of their work. So you can put them to work to dust your office desk, to shred your papers. You get to pay them, and you can write that off as well. They can clean your signs, they can mow the lawn, pull the weeds, they can do data entry for your CRM, any kind of research for you, clean your office filing, and so on and so forth. You will also get to write them off as an expense in your home office. I just wanted to put that out there because I had made a little note about that. Fees and licensing, memberships and insurance, you get to write those off. Software and business tools, you get to write those off. Gifts, it gets a little funny here for realtors because we have a cap on the gifts that we can give, which comes at it's very low. I think it's up to $25 to $45. But there's a little twerk here that you can do. I give Dom Perignon for people who do business with me. And so if you actually attach your card to it and or put a sticker on there from Cotton Realty, it becomes advertising and marketing as opposed to a gift. So know that you can give your clients better gifts than $45. Health insurance. Now, if you are, in my case, I'm married and my husband works for City and County of San Francisco. So our health insurance is through him. But if you're single or if your husband does not have health insurance and you have covered California or in Blue Cross Blue Shield, you get to write off your expense for your health insurance. You cannot write it off if you have another source of health insurance. So If your primary is your husband or your better half, or you have a W-2 job that has health insurance, you're not able to write your health insurance out. So that's a caveat there. But in a lot of cases, for especially single realtors, you are paying for your health insurance, you do get to take a write-off there. Meals, and there's several different types of meals. You can only write off a portion of the meals that you have if you're in town. If you are out, for example, if you're going to the midwinter event in San Diego, those meals are 100% you can write off. So keep that in mind. And then you can write off your car and depreciation and gas and mileage. And we'll get more into that. But also on your, if you have a green car, they're giving nice deductions right now, again, for the green cars. So those are some of the write-offs there. It is always important to keep in mind that to be deductible, your real estate business expense must be directly related to your business, ordinary and necessary. So that's the rule for IRS. So keep in mind, you're always trying to ensure that if you're ever audited, you can justify what you've written off. So what to write off and where to write it off at. Here's some tips on where things go. Remember, always consult your own legal and financial advisors. I am not a legal professional, but I am considered a certified tax strategist. So realtor dues and subscriptions, you can write that off. And you know, we use Schedule C, right? So you could write that off in box 27A. So any dues, fees, or subscriptions for realtors, associations, or MLS can be deducted. Property promotions, write off using box 8. So I'm giving you the boxes and where you will find these write-offs, because we a lot of times, I shouldn't say we, I don't always, well, before I got in the business, I didn't necessarily always look at what my tax preparer was writing off for me. I would give her a list of my receipts where she would put them, and I see property is spelled wrong here, and I missed typo, I did this, so, but where she would put them, I never really paid attention. And so I think a lot of things get lost because maybe they don't know always where to put things for us, but here is where you need to look to make sure. A lot of times they pile it all together in one area, but here's where the things actually properly go on your return. So website and hosting fees would go in box 8, Square, Wix, GoDaddy, any website services that you are fully tax deductible. Those, you can make sure they're in your box 8. Workshops, coaching workshops, seminars, that should go in box 27C. And then legal fees, it should go in box 17. So if you any kind of mediations and arbitrations that you spent money on, or any kind of attorney fees, or even your tax accountant fees, CPAs and stuff like that, they would go there in box 17. Licensing fees also will go in box 17. Commissions paid and desk fees, you would find those in box 10. You should look on box 10 to see if they added those there. Your E&O insurance or any other insurance that you would have to for your car and stuff, is that goes in box 15. Any kind of lead generation software that you would use, your CRM and your email, if you use Constant Contact and things of that nature, you could take that right off in box 18. Business cards or any kind of advertisement, you would take that in box number 8. Schedule C, your phone bills. We all have cell phone bills. So on your Schedule C, like I said, a lot of times tax preparers lump these together in one, but it's easier, especially if you're ever audited, to actually know where the things go for you, so you can kind of break it down. Your home phone, which a lot of us don't have anymore, but if you do have a home phone, a portion of that is also a write-off, as well as your cell phone. Other write-offs in places that they would go is your parking and toll. Yesterday, I went to the event in Oakland and had to pay for parking downtown Oakland. So make sure you can put that in box 27A. Car purchases and depreciation would go in box 13. Vehicle toolkit, I encourage every one of you guys, if you don't have a toolkit in your trunk, get one. First aid, flashlight, I have zip ties, scissors, hammers, screws, nails. Put a toolkit, it's a write-off, put it in your car. Your car insurance, your car maintenance, box 9. Business meals, box 24B. Transportation, so if you bought your plane tickets or train tickets or bus tickets to the event for the winter event, that would go in box 24A. Any type of hotel accommodations would also go there, travel lodging. And then meals while you were traveling. Remember, I told you your certain meals, you can only write a portion. If you take out a client to eat, you can only write a portion of that off. But if you're traveling and you are out to dinner while at the conference, that's a full write-off, and that would go in box 24A. Let's see, home office furniture. If you have a home office, I'm actually in my home office, and Marie was saying, oh my God, there's a bed in there, but this is my home office because my kids are back home, and as soon as they get out, I can go back to having a spare bedroom. So cross our fingers, I want them out soon. But your home office furniture, desks, chairs, lamps, all of that will go in box 18. Property repairs, because remember we said that you could write off a portion of your home. So if you had repairs, you could write off up to $2,500 on each repair. So even if it doesn't necessarily have to be for your business, the home write-off. Anything that makes your home operable. So if you had a plumbing issue, it's a part of your home, you use a part of your home as your business, you can take a $2,500 write-off for that too. And you would find that in box 21. Your power bill and your water bill, you also get to take a portion of that. And it won't be on your Schedule C. You need to file a form 8829, and you can find these forms all on the irs.gov website. Your Wi-Fi bill. Well, Comcast is going to get their money, so you got to make sure that you write that off. So that would go in box 25. Your internet is a special caveat for people who are in our industry. We cannot do anything in this industry without the internet. So we get special write-offs for that. And that's kind of my presentation. I'm definitely open for questions. There's a lot of, I could tell you, 100 more loopholes of things you can do, but whoever you select to do your your taxes, make sure they're just knowledgeable about our industry, because our industry, I'm not gonna say it's special, but we get a lot of perks, because we do end up paying a lot in taxes. So we want to make sure we're maximizing every opportunity in this industry. So, you know, when you're interviewing, or if you've been doing taxes with the same person for a while, you know, just ask them to make sure that they're maximizing all of your write-offs, because you have a special industry that we get an opportunity to write off a lot in our industry. So just make sure they're utilizing it. And then this is my information. So if you, I'll put it in the chat as well, and you can contact me if you have any questions. And again, a huge tool for us. I know we have so much information that we have to stay on top of in this industry. I mean, things are forever changing, but and just for self-knowledge, check out, you know, irs.gov, and look up, you know, our industry, you know, realtors, and see what it has on there, because things are forever changing. And there's a lot of lately, in the last three to 5 years, we've gotten a lot of perks. So you know, always try to stay abreast. If you don't, you know, if you don't know something, or you the IRS website is pretty good, and it really has a lot of great information. So I encourage you to check it out sometimes if you have time for toilet reading. So that's my presentation. So anybody can have any questions, and I'll stop sharing my screen now.
So before we start taking questions, Darlene, thank you so much. That was very, very insightful and good information. The one is that, are you able to share that the slides that you actually did present, or the PowerPoint?
Absolutely.
Awesome. And then yeah, just to let you know, this is so important. This information is so important right now, especially in tax season, not only tax season, but for running a business efficiently. If a lot of people get into this business from 9 to 5s, and they forget that they are business owners. So as you can see, that there's a lot of incentives and tax incentives that are here for business owners, specifically the real estate professionals and realtors that actually take advantage of. So I have a couple of hands raised. The first person I see is Marie. Go ahead.
Yeah, hi. Thank you so much, Darlene. I love that information. It's just like how you put it in the little boxes and stuff. Because like I said, I have had my tax guy for quite a long time. So now I gotta make sure that, you know, he's, you know, allocating this stuff, and so I'm getting all it, because I feel like I'm always paying a lot. And so, but I did have a questions regarding, you know, when you own, you know, investment properties. That seems to be where it gets a little more, gets more involved. And how do you know for sure you're maximizing those, like the appreciation and all of that stuff, and repairs, and how do you give an example, because you own a lot of doors or properties. So what would you say in that scenario when you have multiple you know, properties?
So there's two things. The one thing I have found that works for me, and I don't own a lot. I think I don't own 100 doors. I helped, but I do own some. And so here's what I found is that, because we want to write off, you know, but yet we want to make the income. So we have to figure out if we're actually, the numbers make the difference. So if we're actually making the money on the property, the depreciation, it's a formula that you put into the software, and it'll give you the depreciation number. But what happens is, us as property owners, so last year I took a loss on a couple of my properties simply because I did have a lot of repairs, right? For instance, 4 of my houses are in Houston, and they had the freeze. In 3 of my houses, the pipe bust, all the pipes bust. They were older houses. That freeze, it was, you know, everything was down, and I had, you know, some water damage. I had, you know, close to $65,000 in repairs on one house. So I was able to take that write-off. But in most cases, my properties make money. So it becomes a part of income. And it doesn't, and there's really no way around it. If there's not a lot of write-offs that you can justify for the income you're making, right? Like, so a couple of them, I own them free and clear. So every dollar that I take in is considered income. So the only thing I advise is just make sure that you are actually, you know, taking out if you have a property management company, make sure you're taking their fees, make sure you're, you know, if you are doing any kind of repairs, make sure you're, you know, writing those off. But it's harder to justify it if you're making money, if you're actually making money from the income properties. It's just harder to justify. You don't even get the same write-offs that you get on your primary resident, right? So, you know, it's kind of one of those things. Just be real strategic. One of the things I started doing, because someone taught me this, and I don't know if it's a great thing or not, but it's a write-off. But so in the month of December, I don't take rent from my tenants. So that gives me a huge write-off for the following year. So the month of December, especially if my tenants have families and that kind of thing, and if I can afford it, some of the units that I have, I can't afford that. So I give them half. But for some of the properties, especially the ones that I own free and clear, I give them an incentive by not accepting rent. And so if say that rent is $1,500, I get a $3,000 write-off for that. So, you know, you can play with things like that, but for the most part, if you have income property that's making money, it's very hard to take a lot of deductions or to save. You know, you get to take your normal deductions, but I haven't found that loophole yet, but I'm looking.
Okay. Okay, thank you. Let me know when you do.
I will. In which box that goes in, right?
Yes. Yes. Any more questions? All right. Well, Darlene, this information was amazing. I took some notes. I didn't even I think I see Renee, did you have a question?
I'm sorry, Clinton. I was running.
Oh.
I was running in here. We always wonder about cars. Do you take the standard deduction? Do you take the mileage? What do you do? And because we're always in our cars, that's our office, our mobile office. What is your recommendation for the car situation? Thank you.
Okay, so if it's a car that you've already purchased and you didn't purchase it the year before, you take the standard. But if you just recently purchased it, like so if you purchased something in 2023 or 2022, you get a large deduction. But you also can always take your depreciation as well. And the other things, any kind of car repairs, you can take that deduction. Your depreciation, you take that, as well as your gas mileage, you take that. So those are based, and you can also take your car insurance. So a lot of people miss that one. So that's a deduction you can also take for the car. But you know, it's kind of like, yeah, we're in our cars. So there's like 4 deductions you can take on your car, but you know, they don't amount to a whole lot. But and then now if you bought a green car, they're going back to the $4,200 tax deduction from last year. So And then the other question people ask is it better to lease a car or is it better to buy a car?
Yeah. Mhm, mhm.
And it all depends on your situation, right? For a long time, we thought that it was better to lease a car, but now we're finding that that's not, because even when you lease a car, you can't take the repairs. So it kind of depends on you and what you want, but it's not a guaranteed anymore. But it used to be like, oh, it's better to lease a car and you get to write off the interest and blah, blah, blah. But that's not always the case anymore. So it depends on, you know, what the car payment is for you. If it's cheaper for you to pay the car note on a lease car, then I say go with a lease. But if it's you know, cheaper for you to purchase the car, I say, you know, buy the car.
Thank you so much. And one final question, if that's okay.
Come
Yes,
on.
go ahead.
C Corp, S Corp, different, and you know, what do you want to do?
Okay, so we talked about this yesterday and we had a CPA. So that's really far beyond my scope. Everybody is different. Whatever works for you, what works for your business. Of course, with S Corps, you get a lot more tax deductions, but it depends on what your other legal aspects for having a C Corp is. So it basically it's by what type of business you want. Some people that have a lot of income property, they feel like a C Corp is better for protection. I have an S Corp, so I can't justify that. But you know, when you're thinking about it, you know, maybe sit down with a licensed CPA or an attorney, a tax attorney, find out what will work.
We do have an S Corp, which we've used, but someone's been saying, oh, you should go to the S, and there's something else. If you make 250,000 or less, there's another pass through. So
oh yeah, there is a pass through that you can have a C Corp and have a pass through. But it gets so convoluted, right?
Yes. Right.
And,
Yeah.
and also full disclosure
Thanks so
too,
much.
we have to make this disclosure that Darlene has experience in taxes and tax deductions because of her background, but she is not a tax attorney, or a certified CPA. So as real estate professionals, we have, if you want any in-depth questions about taxes, or if you want to refer your clients, also we can have this conversation among ourselves as real estate professionals, but and then with your clients, you do have to refer them to a tax professional, all right? Especially with your investor clients and stuff too, okay? So, so at the same time, Darlene is available to answer any questions about tax deductions and some of the deductions she, in her personal experience and working with some of her clients, is doing for them and herself. So, yes, any more questions as we move forward? All right, so we'll end. We have like 2 more minutes before the hour. I want to say thank you for Darlene again for actually coming on and gracing us with the information. It was very vital information right now. I'm going to take a lot of notes. As I said, we do run businesses, so I mean, this is a very important for us to know, especially when we want to stay on top of our taxes. A lot of times we just give it, we just give our contents the QuickBooks, and they get access to it, and then we get the documents to sign. But just knowing these things, you can review the documents and look at the boxes and say, oh, well, I did have a deduction in this box here, and it qualifies. Actually, now you can ask your tax accountant and refer back to the information we just got. So as we end, said thank you again. And as we end, we'll have our last words from our president, Madam President, Ms. Frances Young. But before we do that, just want to remind everybody about the conference coming up in next week, actually, the 23rd to the 26th of February. I don't know, do we still have open registration?
It has been in discussion about the registration. So offline, if you had someone that wanted to register, then just let me know, and then I can reach out to the NAREB team to find out. So I don't want to say yes, but it has been discussed about registration. Okay. Now, and the rooms. since we're talking about it, if you need a room, then just let me know, and then we could probably see if a room is available. I know they worked on the overflow, but there may be something that we can do to help.
Awesome.
Mhm.
So moving forward to, as I said, we will resume our Power. Remember, it's the Power Hours, the third Thursdays of every month. And I'm hoping to see everybody at the conference, and I'll give the floor over to Madam Frances Young, our president.
Thank you, Mr. Clinton. Again, we appreciate your support. The information that's being provided to us is well received. And we would just love for you to just stay tuned on a monthly basis and help support us with this Our Power. So other than that, see you at Midwinter, and God
I have
bless.
one other thing to say, and so if you have not renewed your membership, if you can do that as well. We are always looking for our members. Your membership goes to national as well as to your local board and to CAREB as well. Okay. And Madam Maria, I'm gonna have to start to give you the script, okay?
I'm not a salesperson, but yeah, you'll hear from me.
Or they say, don't give me the mic about membership, okay?
Right. Like push that membership.
I guess, but
Look out
this
for
is,
our digital magazine this month. It'll be coming out shortly as well. And you'll definitely want to represent with your profile. We have some excellent, nice profile borders from NARAB, from National, to get the word out about democracy and housing by letting everyone know that you are a Realtist and a member of the Realtist Association, National Association of Real Estate Brokers. So be sure to look out for that.
I can't wait.
Yeah.
I just want to add, for those that may not know, if you want to ask Rhea, what's good?
What's good? I have it in my background.
Yes,
What's good this month is definitely
What's
Midwinter.
good?
I am so excited. The lineup is phenomenal. So I know we'll come away with more tools in our toolbox to dominate the market for sure.
That's
Excellent.
right.
I'm so glad you're doing the what's good, okay?
Yeah.
Yes,
All right.
All right, you
All right.
guys, we know
Okay.
it's having fun. Thank you all.
All
All
right.
right, have a blessed week.
Yeah,
See
you
y'all
see, I'm already in
I see.
position.
I
I'm
got
already
you.
working on it.
I see you.
Don't even worry about it. I got this handled. Bye.
All right,
All
everybody.
right,
Have a
you
good
guys. Thanks. Okay.
bye.
All right.